Hey everybody, welcome back to 5 Minute Financial Markets. Another down day on the S&P, the fourth day in a row, and things are really starting to look ugly out there, but all hope is not lost. Let's take a quick look at the intraday chart. Looking at the 1 minute chart, we opened right up here at 383, pretty much exactly where we closed on Friday, and just ground down all day long. Had a little bit of support here at 381.04, which was last week's low. I've talked about it many times. Previous week's highs and lows, previous days' highs and lows are often very strong levels of support and resistance on the S&P. Have those lines on your charts if you're day trading. Another thing I've talked about several times before, and it was on full display here today, is this concept of when you see the S&P moving in a single direction, making smaller, incremental, higher highs throughout the day or lower lows throughout the day, there's a very good chance it's going to continue to do that all the way into the close or nearly to the close. Here's what I mean. So we opened at 383. We started with some slightly lower lows. Each one of these is just a little bit lower than the one before. Here we have another lower low. And by the time we get to, 9 a.m. Pacific, we've had about 15 lower lows already, maybe 20. On days like that, there's a lot of momentum that's just going to keep pushing that market lower, as opposed to a big move down and then retrace up and chopping down like this. Those days are less predictable, but when you get this repeated series of slightly lower lows, not big moves, but just a few cents, 10 cents, 15 cents lower than the previous low, that tends to run all the way into the close or near the close. So what you could have done if you were watching this, once we got to here, now you've had about 15 or 20 lower lows already by 8:40 a.m., and then it caught a bid, rebounded above this previous week's low, 381.04, found some support there, and chopped around a little bit. But once you see it eclipse this previous low right here, now you can feel pretty confident that it's going to keep moving lower through the end of the day. So at this point, it was at 380.43. So you could buy a same day put at 380 or 379 to maximize gamma and get the most bang for your buck. And then as you're moving lower, just put in a trailing stop so that if it does bounce back up like this or come back up rising into the close, you still lock in your profit. A quick day trade like that could have netted you 60 to 70% today. Now let's look at the bigger picture, switching over to the daily chart. As I said, the fourth down day in a row, the fifth red candle in a row, because this day, CPI day last week, gapped up higher at the open and sold off from there. So this chart's looking pretty bad. So I'm going to give you the bearish and the bullish case. The bearish case going forward, we're not even down to oversold territory yet on the RSI. We're only at about 39. So this could definitely push lower, back down to 374, which is right around the weekly expected move. It could even find this support down here at 369, or if we get really bearish action, it could come all the way down to this 200-week moving average, which would be in the mid 60s by the time it gets down there. I think that would take some serious negative news to push it down there. And there's no news on the calendar, no jobs reports, no FOMC meetings, no CPI inflation reports, nothing like that that are the typical big market movers. Obviously, something could come out of left field and move markets around that we don't expect, but there are no big market moving news releases scheduled on the calendar between now and the end of the year. That said, I'm leaning slightly more toward the bullish case, at least in the very short term. I think we found a little bit of support here, and you may notice this new pink line if you're extremely observant and have been watching the videos. This pink line hasn't been on the chart before. So what is this pink line? This is the neckline going all the way back to the big head and shoulders that broke earlier this year. So late 2021, we had this shoulder formation, the big head that peaked in January, and the second shoulder where the market eventually broke lower. So if you follow that trend line all the way through, you can see that there's been a lot of support and resistance as prices have approached that neckline. And we just touched on it today and bounced off. You can see when we look closer, it came down and touched this neckline exactly and found some support. So that's one data point that gives me a little bit of an indication that we might catch a bid here, bounce back up to this 390 level before resuming the sell-off. The other data point I'm looking at is this divergence chart, which I've shown you before. This is the smart money, dumb money divergence. Smart money being the bond market, HYG, high yield bonds, dumb money being the S&P or equities. So in the past, whenever we've had big divergences between the bond market and the stock market, the bond market's usually right. One example, and there's several going back, and you can see that in my other videos. But here we had, between June and August, we had a much higher high on the S&P. During that same period, we had a much lower low on the HYG. And after that, the equities and bond markets both sold off. Here we see another divergence forming, and it's hanging on by a thread, but it's still intact. So the S&P has made lower lows from this November 15th or so to the last few days, while the high yield bonds are still barely holding on to a higher high. It's still slightly uptrending from that November 15th low. So as long as that holds, that is near-term bullish. It looks like the bond market at least sees some strength, or at least doesn't see a reason to push down a lower low. And so I think we could see a little bit of a retrace, a little bit of a consolidation to the upside, and that's bullish in the short term for stocks. Now, if tomorrow or the next day we see a lower low on the HYG, then this divergence is no longer valid, and we have to assume we're heading lower. Personally, I bought some very short-term SPY calls at the end of the day today, expecting a little bit of a bounce. If it does bounce back up to 385, 390, I'm going to start taking profits at 385 and close out the entire position at 390 and look to get into some puts for more downside moves going forward. The last thing I want to look at is the May 2023 Fed funds rate futures contract. The reason this is important is because May 2023 is where the futures market expects the Fed to hit their peak interest rate or their terminal interest rate. And you can see back here in November, that was way up here at 5.25%. Now it's down to 4.875% and heading lower in this price channel. The more this rate moves down, the better that is for the economy, the stock market, everything. That means that the Fed won't have to hike rates as much as we expected back in November. If this keeps heading lower, that continues to be good news for the market going forward. But these are very turbulent times right now. Make sure you're practicing good risk management, preserving your capital, and staying safe out there. Thanks for watching, and we'll see you next time.